So number one, then the answer. Number two, then the answer. You don't have to write out the question for me. I know what it is. Just put number one and then what the answer is for your specific company. Okay? Operating risk is business risk. What kind of business risks do they have, right? If you're an airline company, what kind of business risks do you have?
Weather.
Say it.
Weather.
Weather, possibility.
Volcanoes, yes,
Oil,
oil.
right? I'm dependent on jet fuel quite a bit.
Hazardous.
Crashes, things like that, that affects your business, right? Even if you're not the company whose airline disappeared, right? Or plane disappeared, it still affects your industry. That's a business risk.
Yeah.
Financial risk is just you loading up the company with too much debt. Okay? A company can fail from both business risk and finance risk. What's usually more likely is business risk. Your business just doesn't work out.
You mean the financial risk of the question number 2?
Mm-hmm. So you want to look at the debt of the company.
Okay.
Okay, just like for business risk, so it's gonna be like, each company has different like business risk. It's not gonna
Oh
be
yeah, absolutely.
specialized to that company.
Absolutely.
Okay.
Mhm. You just, I mean, it doesn't have to be anything technical, it's just like from your understanding of the company, what's a business risk? Right? What about a restaurant? What about McDonald's? What's a risk for them?
Good market, McDonald's business goes down. Bad market, McDonald's business goes up.
Because they create the dollar menu, right?
You can't skip this Geico ad because it's already over. Geico, 15 minutes can save you 50% more on car insurance.
Oh, I got the Bulls game over here, 32-27. In case you're wondering, they're losing already. So in a bad economy, they have a tendency to do better. Why? Because people maybe don't go to where? Applebee's or places like that. They'll just go fast food, dollar menu, right? What's the other risk for competitors too? McDonald's have a lot of competitors.
Yes.
Yes.
Burger King, Wendy's.
All right, so we consider McDonald's. You consider McDonald's above those, though?
Yes, actually, yes.
Kind of, right? Mm-hmm.
I think it's really having problems because of like more upscale stuff like Five Guys and
Right. If you want a hamburger, go to a place that just does hamburgers. Do they do them well? Yeah, they do them pretty good, right? Is it different than McDonald's? Yeah. How about broil versus fried? Use a broiler versus fried. That's what Five Guys does. That's what a lot of burger places do. Go to a place that does that, you know I'm going to get a hamburger and fries, it's going to be good. You go to McDonald's, well, they got burgers, they've got chicken, they've got, right? Right. If they try to satisfy everybody, but sometimes that's a business risk because you have too much on your menu. Healthy, people getting healthier, that's a risk of McDonald's, right? Because people, how do I say this? People will think Chipotle is healthier. It all depends what you get on your burrito, right? But people go, oh, Chipotle is healthier. Oh, Subway is healthier. Well, it depends what you get on your sub sandwich, right? Put a bunch of mayonnaise and ranch dressing on that sub, guess what? It's not healthy. So that's another business risk too for them.
What did you say that the burrito from Chipotle was like 3 Big Macs? Full loaded?
Fully loaded? Yeah.
Fully loaded,
But
yeah.
people think that people's, oh, it's healthy. It's
Burrito.
right. Or their, what do they call it? Their beef and their chicken is not processed, what do they call it? Yeah, kind of like, not free range, but you know what I mean?
GMO?
There's no, that's not genetically modified or whatever.
No hormones.
No hormones, exactly.
So how about like the change of like the taste of customer and like people right now, they are like converting toward organic and natural food.
Right.
So discussing myself, I try just to get like healthy food, cooking at home,
Mhm.
organic veggie and fruit.
Mhm.
So if people turn to go this way, so it is a risk for McDonald's.
Right. Well, think about the supermarket Whole Foods.
Mhm.
5 to 7 years ago, there was a very small portion of your grocery store that had organic, right? Now, guess what? Every grocery store has organic.
Exactly,
That's a risk. Well, what does Whole Foods do that's different?
yeah.
Is there anything special? Because if we see organic and we can see an organic a little cheaper, we're already at that grocery store anyways. We'll
Yes,
just buy
it's
it then.
cheaper, like comparing to Whole Foods, you can find organic food like in other markets, but it's cheaper, so, yeah, it's becomes cheaper, I don't know why, because a lot of people maybe,
Mhm.
they get like,
Well, Whole Foods compared to some of the huge grocery stores, they don't have as much purchasing power.
yes,
The other part would be like the labor market, because the employees can go on to strike, then it could be a federal rule about increasing the wages.
Mm-hmm.
So that is going to, if the wages are increased, that is going to cut down the profits.
Mhm.
So even if the sales are going to remain the same, but the
Right.
profit has reduced.
Mm-hmm. So those are all different financial risks and operating risks of different companies. Whatever company you pick, will have specific ones. Company have preferred stock. Okay, I'm gonna look for that. Yahoo Finance is a good resource also. There is Morningstar.
So in a lot of these things that you can pick right off Yahoo Finance or Morningstar,
Absolutely.
just pick them right off there. We don't have to show the calculation if we can find it.
If you can find it, yeah.
Okay.
So if I'm looking at direct to Morningstar, so if I'm looking at McDonald's, okay, MCD. No, nobody can do McDonald's because I've shown you this. So here's stock stuff. Key ratios. I want to look for ratios. I can find it there. Gross margin, operating income, book value per share, all those. Stocks, bonds, go to bonds over here. In the bond section, it'll show me the capital structure of the firm. Pulls it up, it sometimes takes a while. So, here's McDonald's. We'll be discussing that today, capital structure. So equity is 44% equity and 55% debt. Any preferred stock? No. So if I had McDonald's, my answer to the question is preferred stock. There's not preferred stock. So that's the capital structure, whatever company you choose. Usually, the more debt the company has, the more it's financed with debt, the more risky it is. But in order to get a better perspective, you have to look at a similar company. Because some industries are very capital intensive. Other industries, not that capital intensive. Okay? And then down here, it lists all their bonds individually, the amounts, what yields they're paying, and so forth. Debt to equity ratio, firm versus industry average. That's what we need to know. So 1.25, but the industry average is 1.55. So McDonald's is a little safer than the industry, a little less debt than the industry on average. Capital structure, that's where we just got that from.
On to the question number 4, we can just answer, does the company have any
Yes
preferred
or no?
stock? No. Right?
Then what is the company's current beta? Beta is a measure of market risk. So we'll pop open, we go to Yahoo Finance. Another way to look up stuff. And we'll do McDonald's. And we'll do key statistics. Okay. There's some information too. There's the beta for McDonald's, 0.76. What does that mean? Beta of 1 means the stock is as risky as the market, S&P 500. Beta greater than 1, more risky. Beta less than 1, less risky. So what the beta is telling us of McDonald's is it's less risky than the market.
That's for number 5, right? The question number
Is
5.
that number 5? No, that's number 6.
6.
What would you think would happen to beta if it's had no long-term debt? Go up or go down?
Oh.
The less debt you have, the less risk, therefore the less beta, the smaller your beta should be.
Depend on, like, they're like running like 2 years, something like that, 2 or 3 years, I think, and that solely, so it takes them a couple of years to make money.
Medical, I mean like a practice or?
Yeah, like chiropractors.
Yeah.
I read an article that, yeah.
But there's, I mean, that got to include their debt of their, being a student debt too, a couple $100,000 worth of student debt that they have too. Plus doctors have huge liability insurance too. If something bad happens, you guess what you're going to do? You're going to sue that doctor. And in the state of Illinois, I know for a fact that it's very friendly with doctor lawsuits. So I know there's an OBGYN who delivers babies. His medical malpractice is $300,000 a year. That's his insurance. Why do people, doctors leave and then go to other states and do it? Because it's a little more doctor friendly than it is people friendly. There's liability in that too. Plus just the nature of the business. There's a lot of business risk being a doctor. Right? Misdiagnosis. I mean, surgeons. Current tax rate. You can Google that and find that. The cost of debt before and after taxes, we would take the cost of debt and multiply it by 1 minus that marginal tax rate that you found out in question 8. Cost of preferred stock, doesn't have preferred stock, that doesn't have preferred stock cost. Cost of equity, we could use a CAPM model, which uses beta. That's probably the easiest model to use. The higher the beta, usually the higher your cost of equity is going to be. Weighted average cost of capital, you guys have done that before, right? The weight, well, once I have the weight of each, just do the cost. And where's the weight? 44%. Times whatever the cost of equity was for McDonald's, 55%, whatever the cost of debt is.
The question number 10, what is the cost, no, 11, what is the cost of the equity, just to check the
equity? You can use 2 different methods. You can use the capital asset pricing model. You know that formula?
No.
Which is the risk-free rate which is usually a 1-year treasury bill, plus beta, which we know where to find, right? The return on the market, which is usually around 9%, minus the risk-free rate. And that'll give me the cost of equity. Since we already used beta's aspirin in the problem already, we might as well just use that from the, use a dividend model. But since we have beta already for another question, we can just do it that way. The higher your beta, the higher your cost of equity is going to be. Now for the cost of debt, could be mean. We have a ton of bonds here, right? That are outstanding. Look for a bond that matures in like 10 years from now. Okay? So for whatever you're choosing, you can arrange this by maturity date. So 10 years from now will be what? 2025? Here you go, right here. 1.29 cost of debt. Use the yield to maturity. Okay. So for cost of debt, I'm going to look for a 10-year bond. Anything in the year 2025. If you don't have anything in 25, use 26 or use 24. Okay?
That number 9 you're saying for the cost of debt?
Mm-hmm. Anything else? Cash dividend yield, that's an equation. Weighted average cost of capital. PE, also found in Yahoo Finance. What's the company stock been doing over the last 5 years? You use a chart. Go to Yahoo Finance. We'll take a look at
Which one is this?
CD, McDonald's.
Number 15.
15? 5 years. 5 years. So let's see. years ago it was 70. Now it's 97. It's gone up, right? Substantially? Not really, right? Like $20 off of 70. They're up about 30% almost, right? Over 5 years. Is that a lot? No, but for McDonald's, it's probably a pretty decent game. Because McDonald's is such a large company. Risk structure, debt to capitalization. Why would you invest in this company? And that's your opinion. And don't forget the last page, or the page after you answer the questions, tell me where you got the information from. Morningstar, Yahoo Finance, whatever website you found it. Just make sure you tell me where it came from. And that's due by next class period. Remember? I don't want it in, paper format. Question number 1, the answer. Question number 2, the answer. And you don't have to write out the question either. Just put number 1. Okay? Make sure to email me. The quicker you email me, the more likely you'll get the company you want to. Okay? Any questions besides that? No? That's nice. No questions?